So today we'll be talking about POI. Let me hide this chart. So I will explain what POI is. So POI is simply what most people already know what POI is. POI is simply, let me just simply point of interest. So POI simply means point of interest. And they are the institutional reference points. Should I write or I don't need to write? Let me just type it. POI, they are the institutional. It's been longer. I've read book. See, I still know what I type. Institutional reference point. Reference point where buyers and sellers are interested in taking their trade. That's what POI means. They are the institutional reference point whereby where buyers and sellers are interested in taking their trade. So now when you after you analyze your chart, after you mark like the buy side liquidity, sell side liquidity, and you want to get a place where after marking all those things, you've seen the break of structure and you already know where your liquidity is, the next liquidity that price come and take out the B. You need to know where price will come to after taking out the B before you can start buying. So those places, they are the POI, they are the institutional reference points where you are interested in taking trade. And the common ones I know and I use, they are the order block. We have order block. We have failed order block. We have FVG. These are the one I use. If you know any other one that you use, you can use them if it works for you. But these are the ones I use. I use order block, I use field order block, then I use FVG. These are the three I use. Now, order block is just like this. Let's say after you have analyzed your trade. Let's say you've analyzed your trade, you've analyzed your charts, and you are interested in another block. Let's say this is another block. Other block is just like um saying you have two candles of two different colors. Now, let's say the green represents buy, while the red represents sell. I'll change this color. I'll need to change the color of my what's it called? Let me see. This red also. Now let's say this green. The green represent the buy, while the red represent the sell. Now, what you need to know to call this on another block is price engulfing display. Let's say in a selling market, let's say market has been selling before. Let's say market has been selling. Let me use, how do I put this? Let's say market has been selling. Then while it was going down, it took out this, then come back to this place, giving us liquidity, then go back down. Then you are interested in any zone around this place. Is either you are interested in fair value gap or order block or field order block. Field order block will surely be around here. Your order block and FVG, they are along this place. We have double FVG. Sometimes double FVG is when there's an FVG here and also an FVG here, but they are the same length. So that one, just leave that one. Just know, let me just put it in simple term that you know. So let's say our zone now is around this place. And let me just use this one so it won't be too much. Let's say our other block is here. Let's say this last candle that went up is green candle. Then the next one that was coming down is now red. So that's what we call other block. The engulfing candle is the other block. Okay, I also use mitigated block, but mitigated block is hard to spot if you are not good. So I won't teach you that one. I'll just teach you this other block and fail other block. So you will not get confused. You may get confused and confuse yourself. I'll show you on chart anyway where other block are and where failed other block are. Now let's say um other block is a place whereby other block where is a place is a situation whereby let's say a price of market was buying, then immediately when price want to change direction, then the candle that follows the buying candle engulf it like this, something like this. The next candle came down bearish and engulfs the last candle that was there. That's other block. Is it that this is for sell side and also for buy side? You have something. How do I duplicate this? There's a way I can duplicate this thing now. How do I duplicate this? I don't think I can duplicate it. Okay, now for sell side, for buying, if you want to buy, this for selling, if you want to sell. For buying, you should have something like this. If you want to mark another block, you should have something like this. First of all, the red one will come, then the green one will engulf it. The green one will engulf it. I change the color. The candle that will follow will be green color. Understand? So the green one will engulf it. So your zone now, this is your zone. Let's say you are in a bullish market in this aspect. Let's say you are in a bullish market. Market was doing something like this. It was going up. Then we have this break. Then after that, price went back up. Then give you liquidity, go back up. Then it will come down to tap this other block around this place. Then it will now buy. Understand? So your POI will be here. Understand? So your POI is now like this. This is where you will be interested in this place to this place. Then for this one is also this place to this place. Understand? And there's a way to mark your other block. There's a way to mark your other block. I'm saying that this class won't be long, but I think it will be a bit long because I need to explain some things. There's a way you need to mark your other block. Now, there are things also about this other block when you want to mark them. Now, in the market, you cannot just see a whole candle close without having wick alongside. You understand? Sometimes the only time it happens is when the market is moving aggressively. You understand? Maybe it wants to create a Marubozu candle that will make the market push very well to the direction that is going. That's when price used to create that kind of candle without wicks. So now, in choosing your other block, if your wick on the candle, let's say this is the wick. How will I draw this thing that will make sense? Let's say this is the wick on the candle. If the wick of the candle is shorter than the body of the candle, you mark the whole candle with the wick. But if the wick of the candle is longer than the body of the candle, you just mark only the body. Now, this is the body, this is the wick. This is the body, this is the wick. I'm saying it again, I'm repeating it again. If the wick of the candle that price engulf is longer than the body, you mark only the body. But if the wick of the candle that the price engulf is shorter than the body, you mark both the wick and the body as your POI. You understand me now? So that's it. Now let me show you an example. Um, let me show you an example of what other blocks are. Let me use another chart. This chart will be messed up. I can show you other block anywhere. I just want to use like structure. Um, I just want to use like structure that we have already marked. Then put it on 4 hours time frame. Where can I quickly see a structure? I don't want to use something that I've written something on. I want to use something that is clean. Okay. Now this good. Looking at this good 4 hours time frame now. This is another block. Market was buying, then immediately market gave us this short candle, then longer body that engulf it. So this place now, if I want to mark my zone on 4 hours time frame, using 4 hours time frame, but the analysis I did was not on 4 hours time frame. I will mark this whole candle, that black one, with the wick, alongside with the wick. I'll mark the whole candle. You understand? That's another block. So that's another block. If Let me drop down to like 30 minutes to show more example of another block. That's for sell. That's for sell other block. For buy other block now. For buy other block. Market is not buying around this place. Let me look for where price respected by and show you something. But you can see other block at anywhere. That's after your analysis. Okay, let's say this is another block. This have a shorter body, and these have a longer body than the wick. So if you want to mark your other block now, your other block will start from the wick of this candle. Understand? The upper wick of the candle to the downside here. So that's your POI for other block. That's other block for you. That's after you have analyzed. I want to look for a place where there's structure, so I can show you what other blocks looks like. Okay, let me use this. Let me look at this chart. Okay, it was FVG. I marked here. Was it FVG? I'll put it on 1 hour. Okay, it was other block I marked here. So other block. Now looking at this chart now, you can see that we have this sweep. We have market taking out the buyer side liquidity, then come down, break down to the other side, reverse, give us liquidity. After giving us this liquidity, what do you notice? There's another block here that price engulf. That's why I marked that zone that I was waiting for. But this zone that I marked here before too is because there is another block here, but I didn't have buy side liquidity. That's why I didn't take this sell, this whole sell that happened. I knew that price would respect that zone. When I wasn't sure, I wasn't like sure enough that price will go down up to this place. That's why I didn't take it. This is another block too. You can see this is another block. For this buy that I took here, it was a risky buy anyway. It was on 4 hours time frame, or what time frame did I use? Let me check. Okay, it was 4 hours time frame. If you can see the place I mark my zone, you can see that I mark it at the extreme end, but price really came back and tapped it, because looking at this now, you can see that the wick of the candle is longer than the body. What did I tell you? I said if the wick of the candle is longer than the body, mark only the body. Now I see this red candle that is within these two. You can see that the wick of the body is very long, and we have a sell side liquidity here, but this place is very dangerous. This buy I took was very dangerous, but it's because I saw a sell side liquidity and I saw liquidity here. That's why I just say let me just risk it for a few pips to get to this zone. So you can see where I mark my zone. I mark it here. Then I took this trade on Friday. After it gave me confirmation, I entered and followed it up to this place. Then I closed it. Then since then, price has started selling. So that's order block for you. Now, let me go back to the chart I was using so I can explain to you what failed order blocks are. Yeah, this one was one of the craziest trade. You didn't tag me. This one, they are just misbehaving. I didn't even check them. Which of the chart was I using? Okay, it was this one. Now, I was talking about um order block. Now let's go to field order block. Who is this one writing on my screen now? Please now. Please don't start. Field order block is like it's not opposite of order block or anything. No. Field order block is just okay. Field order block, let me just say field order block is just like picking your entry from around this place. Let's say in a bullish market now, price is buying, going up, coming down, going up, giving a series of break. But why price is going up and down? Price will be creating maybe support resistance level where price will like want to reverse. Let's say the resistance zone is around this place, but price broke it up. After price broke this resistance zone to this side, then it reverse, taking out this place. After price take out this place, you'll be expecting like to sell from around this place. Maybe after price has given you maybe a pullback like this for more liquidity, you'll be expecting to sell if you have any zone around this place that is serving as field order block. Let me show you. Let me do something. Now looking at this now, I told you that this was order block, right? And this the zone we're interested in before to buy from. You understand? Let's say price started going up from here after price has I'm coming. Let's say around this area. No. Let me say price was going up after price created this stuff, created this order block. Price started going up, came back to give us liquidity. It didn't give us full liquidity. Okay, let me just use this. This one makes sense. I say price started going up, then it came down like this and went up a little bit like this. It didn't give us up to 50% reversal of the liquidity. I said it should be up to 50% when you use your fib. Then price now drop, taking out this our zone that we mark. After price take out this our zone that we mark, it now went above, giving us pullback, then give us up to 50% reversal. Then this zone now will now become our zone that we are interested in selling from. So that's where we call it failed order block. Then we are interested in selling from there. That means price has changed character from buying to selling. So that's just the difference between order block and failed order block. The zone whereby the order block did not hold, that's the zone you call your failed order block. But yes, that's where you call your failed order block. The zone where you mark for order block to hold, maybe to continue the direction into the direction, but price failed to respect that zone. You call that place your failed order block. Also for this one, let me also make example with this. Let's say you are trying to um sell from here because price has been selling, then price gave you a good zone. Maybe after price has given a good pullback, price gave you this zone to sell from. Then immediately price drop, sold for a while, give you this pullback. Then instead of price to give you up to 50% reversal, then price didn't give you up for 50% reversal. It was just giving you this reaction. Then immediately you are seeing all this reaction. Then immediately you see price taking it out. After price take it out like this, then it come down to give you pullback, then continuation. Then next thing you'll be interested in this zone. Understand? Then you continue buying. So I can also show you an example if we can get an example on the chart. Let me look for an example that we'll use for failed order block where they play out. Let me just use a lower time frame. I think we could get example faster. Failed order block. And put on 30-minute time frame. Okay, this is an example of perfect failed order block. You can see this place. Looking at this place now, this zone here, this is another block the price was supposed to respect. This place is another block that price was supposed to respect because we already have market giving us what sell side liquidity here. But when price after price go up, breaking above this place, what did you see? Did you see any good pullback before continuation? You didn't see any pullback. Price was just coming aggressively. You understand? No good pullback. If you look at this now, I was telling you I've always told you that when price is going up to give you liquidity later, it should give you a good pullback, then continuation. But this one, you are just seeing price going up. Then when it started coming down, assuming when price tap into this zone that I marked here before, and as it was coming down like this, then it give you another pullback around this place. At least this place, there will be likelihood of, let's say, 70% chance that, okay, price will continue the buy. But looking at it now, there was no pullback. There was no pullback at all. There was no pullback even up to, let's say, assuming we have something like this from here to around this place. Then when it's coming back, it will have respected this other block here to buy. But we don't have that. So what did price do? Price broke below it. Then after price broke below it, then price now did what? Give us a pullback, then reversal. If you use your Fibonacci now, what will you see? Mark from year to year. What's this? Is it not up to 50%? Yeah, it's good. That's why this place now hold. That's why it held. Don't mind my English, I just mix everything together. You can see the reason why it held. That's why this failed order block. Now, if price broke below your order block, it has become a failed order block. You understand? So after price broke below it, consider reverse back into it immediately, fast, then start selling. Start selling. Hope you understand what I'm doing. Now, if you also look at this from year to year, from year to year, the place that price started selling from is still within our 50%. If you see, look at it very well. Is it not within 50% that I tap into that I started selling from? It's within. If you take the swing, if you use just basic market structure yourself, you still follow it and make this profit. If you use that daily range that I taught you yesterday, it will still make profit with it. So that just is simple like that. This is good. Understand? I'm seeing messages. Hope people can hear me, sure. Let me look at the message so it won't be as if I'm talking to myself alone. I am happy over this last example you gave for God. Am I not recording the class? I'm recording it now. I will explain the field of that block. How many times will I explain it? You watch the video again. You cannot get it once. Watch the video and get it later. Now, for fair value gap, how will I put fair value gap? Fair value gap, what definition will I give it? FVG. Let me just type it here. I don't need to go back to that place. FVG. What's definition for FVG? It's just maybe let's say in a moving market, let's say market was moving aggressively. Let's say market was moving aggressively. Um in that moment the market was moving aggressively. This one that I mark up here is FVG. Let's say market was moving aggressively, like this one that is happening now, that is moving aggressively. Then even if you are not using that aggressive movement style, let's say after you have seen you mark all your structure, where market was leaving your structure going to the upside or downside, then you saw a place where market was creating three candles following each other. It doesn't matter the color of the candle. It could be the same color. It could be different color. You understand? Then when market close, sometime they used to give space in the middle, but most of the time they don't used to have space in the middle. So that place where there is space in the middle is where you call your fair value gap. Sometimes market may reverse and close, let's say something like this. Let's say in a bullish market now, I put this thing. Let's say market was buying. Most of the time, market will give this kind of movement in the market. To give this kind of movement, there will not be space in the middle. There will not be space. But anywhere where you see like this type of candle creating this type of thing in your preferred zone, maybe in your discount zone or in your premium zone, you will be more interested in that zone compared to your other block or field other block, because those zones they are likely to play out faster than other block and field other block. If I look at this thing now, this place that I mark this field other block from, I can see an FVG within this place. You can see a space within these three candle. Let me delete this. If you take your Fibonacci, you measure from this week of this candle to the week of this candle where there is space in the market. So you'll be interested in taking trade from the one above. That's if you are selling. And if you are buying, you'll be interested in taking trade from the one below. You mark the 50%. This one is more precise. Like it used to play out very well. If price tap into it, you can see when price tap into it. Before when I was marking field order block, I marked this whole place and it cover almost everything. But the FVG, you can see the way you just tap it fast. When tap it, start selling. Even this one that I mark here before, for this price action that happened, it was FVG. It's just that when I use higher time frame now, it was showing on 4 hours time frame. That's why I was using other block, for example, on 4 hours time frame. That's why it was like that. It was FVG I used before. Was it FVG? Is it this FVG? I think it was FVG or something. So it's FVG I use. Can see price tap into the upper side of the FVG immediately. Immediately tap on it like this, start selling. Understand? FVG is like more precise to use, very fast. I don't know the kind of definition I'll give to it, like English word I will use for it. That's just the problem. Let me like search for definition of FVG. Maybe I can use it to explain more better. Mm. FVG meaning in trade stand for fair value gap. That's fair value gap. A concept. I need simple definition. Fair value gap. A price action concept where a price move rapidly in one direction, creating a gap between the high of a preceding candle. Where price creates gaps between three candles. That's what I'm just trying to say. It's just that I don't know the kind of English I'll use. That's it. But you understand from what I just show you on the chat. It's the understanding that matters. You don't need to cram the English. Understand? You just need the understanding. You don't need to cram the English. Those are the POIs I use. After I analyze my chart, they are the POIs I use. I don't use more than those three. Understand? Don't use more than those three. Breaker block also a POI. Breaker block is also POI now. It's also POI. Ah, breaker block. Okay, mitigated block is field order block. Breaker block. Before I'll look for example of that one now. Just use these three. These three they are best. They are best. The breaker block is those breaker block, they don't usually play out most of the time. And breaker block, this out there. How will I put this example for breaker block? Breaker block, breaker block. Ehen. Most time breaker block don't play out. For breaker block now, um, let's say, let me look for an example of breaker block for you. Breaker block is something like this. For breaker block, you will not have buy side liquidity taken out. Let's say you have your order block here. Let's say you have your order block here. Then price was selling, then price went back up. When it was coming back, it will not take out this low. It will just start going up. So this area here where you mark as order block, that price went above that place, when price is reversing back to it, that's breaker block. The difference is not that much compared to failed order block. It's not that much. But for failed order block, you have buy side liquidity taken out or sell side liquidity taken out. But for breaker block, it will just create like two a double top. It will create like double top. So that one you may not find it in the market always. And it's not that they always play out. It's not that they always play out always. Sometimes they will play out, but not for long. Doesn't play out for long. Understand? So that's just it. Just use this one I taught you. Just use the FVG and what's it called? Use the FVG and other block and field other block. You'll be good with that. You don't need plenty. Don't need plenty. So I'll stop recording. I will so you can ask your question.